BioCentury This Week is brought to you by Icon Biotech. As a world-leading healthcare intelligence and clinical research organization dedicated to the needs of small and mid-sized biopharma companies, Icon Biotech helps biotech organizations meet their critical milestones and deliver data and evidence-based results to investors, large pharma partners, and regulatory authorities. Icon Biotech advances clinical research by offering integrated outsourced services and solutions delivered by dedicated biotech teams and management that understand the different pressures faced by biotechs in their drive to solve today's challenges without losing sight of their mission to deliver life-changing innovations tomorrow.
Publicly traded UK biopharma investment firm and biotech company builder Syncona is restructuring its fund amid ongoing market challenges for the biopharmaceutical industry. What else did we have last week? $1 billion bet placed by Lilly on gene editing company Verve could bolster the pharma's CV pipeline. And more key staff are leaving FDA. What do the departures of Nicole Verdun at CBER and acting CDER director Jacqueline Corrigan-Curry mean for the agency and for sponsors? Plus, the biggest biopharma IPO in 2 years on NASDAQ, new FDA commissioner's priority voucher, and more obesity data. I'm Jeff Cranmer, executive editor here at BioCentury, and joining me on today's podcast are
Simon Fishburne, editor-in-chief.
Paul Bonanos, director of Biopharma Intelligence.
Stephen Hansen, director of Biopharma Intelligence.
And Steve Usden, Washington editor.
Okay, delighted to have Simone back. We will get some of her thoughts a little bit later in the podcast. But first, let's turn to the UK and Syncona. Syncona is planning to turn its existing evergreen biotech investment fund into a closed-end vehicle that returns funds to shareholders, and then the firm hopes to raise a new private evergreen fund to continue investing in startups. Paul, you had a chance to speak with Syncona. What did you learn?
I did. And first, let me give you a little background on how this is coming together. So Syncona has been around about 13 years. It was launched with the backing of the Wellcome Trust. It's made a substantial number of investments. Some gene therapy companies in particular have attracted some attention. Its portfolio is wider than that, though. And unlike most venture firms, Syncona is publicly traded in London. And it's been a tough slog lately, as it has been for all public biotechs. They're transparent about their own accounting. Many of their portfolio companies appear to be doing fine. Some have had step-ups in valuation recently, but on the whole, their share price is down. I believe the company said 52% over about 3 years. So they're in a bit of a tough spot. And what are they doing now? Well, so as you say, the fund it had been managing was an evergreen fund. That means when it generates returns from either the sale of a company or an IPO that results in liquidity, the firm funnels its cash back into the fund to make more investments. That's in contrast to what most VCs do, which is operate closed-end funds where they raise a specified amount of cash, make some number of investments, and then those companies have their outcomes, and the firm evaluates the performance of the fund over however many years. Syncona has not worked that way. It's been evergreen all along. But now, in a tough spot, the firm has decided to convert its existing fund into a closed-end fund after all. So it will use its remaining cash, which is about £218 million, to support the existing portfolio, and it'll make decisions about how to allocate what it has, and then steer these companies toward the exits while not making new investments from the fund anymore. So it's abandoning some goals it had set out for the 2032 timeframe, hoping to make 3 new deals a year. They're not doing that with this fund at all. But at the same time, as you say, they're hoping to raise a new fund, which will be evergreen. It'll just be separate from the publicly traded entity, and it will make new deals on that side. So from my conversations with the managing partner there last week, my understanding is they like the evergreen model. They've always liked the evergreen model. They just don't think it's compatible with being in the public markets anymore. So the publicly traded entity will now have a goal of creating exits without making new deals. The private fund will make new deals and will be evergreen. And hopefully their own investors, the LPs whose cash they put into startups, will be happy with the arrangement. And in my conversation, the partner acknowledged that some investors have been frustrated and just want to take returns and go, but many are willing to explore a new structure. So that's what they're hoping to do. And there is a path for existing investors to roll their interest from the first fund into the second.
Paul, so first of all, just to clarify, I'm assuming that it is the market conditions that are driving this change, like the fact that, it's really been hard to provide returns to the investors in this market. My first question really is, from the company's points of view, company creation has been what they're known for. I understand that they're not going for the goals that they'd originally set up, but for innovators, should they still be going to Syncona as a company creator? Has their focus changed? They did a lot of gene therapy things. What do you know about that?
Well, I think they're hoping to continue creating new companies with the new fund. I don't know if it will be at the pace that they had been at or had hoped to achieve, which was 3 new companies a year. I mentioned gene therapy. It may not be as strong an area of focus. And as we've written, gene therapy companies have struggled all along. I can mention that they created a new incubator recently. I believe it is called Slingshot. Yes, Slingshot, that will be mostly focused on small molecules. And the partner indicated that the incubator will continue to operate under the Syncona umbrella. So yes, they will continue to create and drive forward young companies, assuming everything comes together with the new fund. And it doesn't sound like there's a major shift in focus for them as far as therapeutic areas or company types that they'll be creating. I can also say that some of the exits that they've been able to achieve were in the gene therapy area. Gyroscope and Nightstar are 2 of them. But also, one of the biggest drags on its share price over the past year was the performance of Autolus, publicly traded company that they backed that has lost a lot of value. They may continue to refresh their gene therapy portfolio over time, but they will invest in a fairly broad set of areas, as far as I know.
All right. Well, staying with the public markets, we had a little bit of a surprise late last week. A company called Caris landed on NASDAQ, and dare I say, the company stuck its landing, raising $494 million. It bumped up its range, I think, once, and then it beat the range. Is that right, Paul?
Yes, they had raised their anticipated range, and then they priced above that range.
And then the amount raised is the most in a new to NASDAQ biotech raise since the $621 million offering by Accelerin in May 2023. Now, Caris company is a little bit different than a lot of the IPOs that we track closely here at BioCentury. It has revenue. Last year, it had over $400 million in revenue from its molecular profiling and pharma R&D services unit. So, Stephen, I know you've already started talking to people for your next quarter preview. Are people expecting a mad rush to go public now, or is this sort of a one-off, do you think?
No. I mean, I think the key is what you just mentioned. They already have revenue, right? And I think that's a real differentiator here. There's obviously all levels of risk in biotech, but this is, what you might call a less risky sort of company to take public. And so I wouldn't take this and extrapolate it to have any meaning for therapeutics company that's looking to go public. I think those are still a ways off.
It's also 17 years old, right? They've been around for a while, and they've worked with clinical, academic, and biopharma companies in support of precision medicine for some time, right? It's mostly in oncology. They have a tissue-based profiling product and another newer one for blood-based profiling, right?
Yeah. And we should also give a hat tip to, I'm not quite sure how to pronounce this, Jong Biotech. That's Jyong. They've been trying to get out on NASDAQ for about 2 years, and they did just that last week, raising $20 million. The company, again from Taiwan, develops therapies for urinary system diseases. So hats off to them.
And I also think it's worth mentioning in the aftermarket, Caris, its shares rose about 30% on the first day. I think they were down a few ticks this morning as we speak, but mostly it's held its gains. So that's a good sign, right?
Yep. Certainly happy to see there for Karis. All right, let's turn to Lilly paying $1 billion for cardiovascular base editing company Verve. Stephen, you and our colleague Lauren Martz did a story on this last week. How are you thinking about the deal?
Yeah, thanks, Jeff. Obviously everyone knows Lilly is the largest biopharma company right now by market cap, and they, as everyone mostly knows, got there through their cardiometabolic programs, through tirzepatide and obesity and diabetes program growth. And so what they're doing is they're building what I sort of termed, I guess, a fledgling CV pipeline, because CV sort of an obvious adjacent area for them to move into, considering that some of their tirzepatide, Zepbound, Mounjaro already have indications that are in, cardiovascular areas like heart failure, or they're being tested in these areas. So effectively, Lilly has built up this pipeline. They've got quite a few programs, but in particular, they've got a phase 3 asset, an siRNA targeting Lp(a), and then they have a small molecule targeting Lp(a). Really, I just looked at this as, they've got multiple modalities in CV that they're building up, and this really is an option for them. I think gives them optionality in terms of, I know Lauren has talked about in previous podcasts about a lot of the safety issues that these gene editing platforms may face, liver tox issues, efficacy, all the concerns there. But I think, to me, the way I read this is Lilly taking $1 billion and saying, if there's a chance, it might be a long shot, but if there's a chance that these base editors end up proving to be, more efficacious and proving to be ones that patients are willing to take in these settings, then it sort of shores up their options should these win out.
Yeah, I mean, I have to say, I looked at this deal and we discussed it, and I thought, if this were any other company, I'd think it was a little insane, to be quite honest, to take this gamble. But, Lilly has more money than the rest of the world put together, basically. I mean, maybe that's an exaggeration, but it's only got a lot of money. And, what we have seen with their Alzheimer's program, but also with their obesity program, is that they're willing to play the long game, and that we know that they can afford to put $1 billion to something that could be a big payoff. Let's be clear, they're going against siRNAs, against Lp(a), and not entirely clear what their advantage would be. I know people who think that it is very risky to be going after large diseases, chronic diseases, with gene therapies. I believe they're going after a rare population within this to start with. But right. I don't know, Stephen, do you think that is really an entry and that they would plan to go bigger after that? Is that how you would read it?
So we know that Verve, their lead program is actually, it targets PCSK9, and they were initially going after patients with heterozygous familial hypercholesterolemia, which is a rare but not a tiny population. So they were starting small, but they very explicitly had in their plans that as they would sort of move this through, they would start progressing out to larger and larger indications. And so that's why Verve was sort of seen as the, to use the cliche, the poster child for taking these technologies that have thus far largely been focused on very rare or ultra rare settings, and seeing whether you could apply it to a much more broader common disease setting. And so to me, I think that's the appeal that there is for Lilly, is that this, again, the Lp(a) opportunity jumped out to me because this has been a very hot target, with other companies going in with siRNAs. And if the biology there pans out, Lp(a) is thought to be elevated in about 20% of the general population. And so that's a fairly large opportunity if you can address it, with a therapeutic input. And so if they now have 3 different modalities going after that, I think they're just kind of looking to cover all their bases, because, we don't know which modality is necessarily going to be preferred by regulators, by patients, and that sort of thing. So I read this as them covering their bases, really.
Excellent. Well, Stephen and Lauren's story can be found at biocenturypodcast.com. Stephen, last week, very busy for obesity. I know we talked about, I believe, the Metsera data on last week's pod, but it just kept coming. Anything else you want to highlight?
Yeah, just a few quickly. So we had the Metsera where we talked about their amylin program. And then this past week, we got more data from Lilly on their amylin program, which looked very good as well. So that was an interesting one. The amylin sort of continues to climb up with interest. And speaking of that, we're also going to have coming this week the BioCentury show, where we're going to be talking to Adam Steensberg, the president and CEO of Zealand Pharma, where we spent quite a bit of time discussing their amylin program, petrelintide, which had the massive deal with Roche. So everyone can look forward to that. But yes, so the loralintide data from Lilly was really impressive last week. They showed very good weight loss, really impressive weight loss, actually, in a fairly short period, 11.5% over 12 weeks. Then the other area that we've been spending a lot of time on is looking at improving the quality of the weight loss. And so that's largely focused on fat mass loss and preserving lean mass. And so one of those targets is myostatin. And there was data from Scholar Rock that was really impressive, actually. It was really good. So theirs is a myostatin inhibitor, apitegromab, which they gave in combination with Zepbound from Lilly. And that showed nearly 55% lean mass preservation versus Zepbound alone. So it's a really interesting starting point. The only sort of wrinkle that I think people got hung up on there was the fact that Zepbound alone showed more weight loss compared to the combination. But I guess in my mind, I don't see this sort of mechanism as one that you're really looking to drive additional weight loss. It's really, I think this is an opportunity where you might see this. This is sort of a maintenance setting opportunity. So you get the weight off initially with a combination of some sort, but then you can transition onto something like this as a way of keeping that weight off and making sure that the weight that is lost is, mostly fat mass. So interesting data, and I think there'll be more of this coming sort of as we progress through the summer.
Well, Stephen, thanks as always for keeping your eye on the obesity space for us. And I look forward to seeing your BioCentury show debut as host. I'm sure you broke a leg. Is that what the kids still say when they do something new?
Yeah, I broke something. I'm not sure if it was my leg. But
all right, Stephen. Well, I know it's Mama Hansen's birthday tonight, so I'm going to let you take off, and we're going to go to a quick break, and we'll be back to talk FDA.
BioCentury This Week is supported by the BioCentury Conference Series. For 3 decades, BioCentury has helped biopharma executives and investors make business-critical decisions and build larger networks with peers across the biopharma innovation ecosystem. Our goals are simple. Gather the right people in the room to partner, network, and debate critical issues facing the biotech industry. BioCentury's upcoming events span the globe and feature topics from translation to company building to deal making and investment. We hope to see you on the road at an upcoming BioCentury event. Visit biocenturyontheroad.com for more information and to register.
We are back on the BioCentury This Week podcast, and I'm pleased to say Simone is back after a few weeks away. She was off in Chicago for our BioCentury Grand Rounds conference. We are gearing up for part 2 of that this year, BioCentury Grand Rounds Europe, which will be in Cambridge this September. And then Simone went off to Israel, and what a time to be in Israel, dare I say. Simone, welcome back.
Thank you. And I'm sure you'll all believe me when I tell you it is good to be back. Went for a family event, and our time there got extended by the closure of airspace. So pretty difficult time to be there. A lot of things crystallized for you, and certainly in your terms of your exit plan, which I might be writing about. But one thing I do want to note is that one of the missiles hit my alma mater for my PhD, the Weizmann Institute, caused some very significant damage there. It didn't affect any individuals, fortunately, or harm any individuals, but it did take out a whole building of cancer research. And, there were reports of people whose 20 years of work was just destroyed, people who'd been gathering samples for longitudinal studies and so on. So it really is a setback. What can you say? They are rebuilding. It's a very good place. It's a very good institute. There's some fantastic research that is supposed to, as we always at BioCentury talk about, patients are global, and it is intended to support patients everywhere, the kind of research that goes on. So very unfortunate that that was taken out. But as you say, good to be back.
Yes.
And our thoughts are obviously with people everywhere who are sitting under fire. Not a good place to be.
All right, Simone. Well, very happy that you and your family are back safely. I've been obviously following along on the sidelines, and quite an adventure to get back. Good to know that you got to get at least one meal in Athens on the way.
Yeah, I have to tell you one other thing is that I only got one falafel in Israel, which is a low count. I got to tell you, that's a low count.
That's definitely a low count.
Things locked down, so falafel was hard to find.
And my recent adventures were a lot less dramatic. I was advised by our colleague Meredith Durkin-Wolf to get falafel at the baseball stadium in Washington, D.C. My son and I did a little baseball adventure on the East Coast. But as I'm very much a man after our Washington editor's heart, Steve Uston, I had a chili half smoke at the Ben's Chili Bowl stand. And then I was delighted to be chauffeured around town by Steve. Steve, good to see you in person for a change.
Can I just say, you never chauffeur me around town.
Oh, I would anytime. And in fact, I will chauffeur you to a place where you can get some excellent falafel in Washington.
Oh, all right. You're on. Let's dump the podcast. Let's go do that then.
Now, yeah, we in addition to our, it'd be tough to launch a tennis podcast. I always joke about it, but I finally did listen to the tennis podcast that you told me about, Simone, and
pretty good, isn't it?
It's wow. Maybe we could launch a falafel podcast. Is anyone?
Absolutely.
I think so. I think we have what we need for that.
Well, we've had a few more departures at FDA, at least one departure, one pending departure. Nicole Verdun at CBER has left. Acting CEDAR Director Jacqueline Corrigan-Curry will be leaving in the coming weeks. Steve, when we had Stifle's Tim Oppler on our sister podcast, the BioCentury Show, a few weeks ago, he was talking about how, even amid all of the changes going on at FDA right now, one reason for optimism, at least for him, was that Nicole Verdun was very, very good. And it was sort of a sign of stability at the agency. It was a reason for optimism, at least for him, and leading him to feel pretty upbeat about what's going on at FDA. I'm curious, what do these departures mean for the agency, in your opinion, and what do they mean for sponsors?
Well, first, here's a little scorecard to catch up on what's happened. I haven't managed to get all of this into BioCentury in print yet, but I will in the next day or two. So as you said, Nicole Verdun, director of CBER's Office of Therapeutic Products, was also, actually it's called the Super Office, and her deputy, Rachel Anatol, were abruptly placed on administrative leave last week and escorted from FDA headquarters by security. Jacqueline Corrigan-Curry, this morning, we're talking on Monday, who has served as acting director of CEDAR since Patrizia Cavazzoni departed in January, has announced her retirement in July. Vinay Prasad has been triple crowned. In addition to CBER director, now he's FDA's CMO and CSO. As I reported last week, Karim Mikhail, the former CEO of Amarin and longtime Merck executive, has been hired by Commissioner McCary as a senior advisor. He sat in on some of the CEO listening sessions. I've heard that he's been vetted as a possible CEDAR director. To be clear, that doesn't mean he's going to get the job, but we may know very soon who the next CEDAR director is going to be. Verdun's departure stunned gene and cell therapy companies and patient advocates. She's been the key person at CBER driving policies that many in the industry believe are critical to advancing the field. She's also been willing to lean into approvals of therapies for rare diseases with less than perfect data. This, I think, and the sense that she was in close alignment with Peter Marks, the former CBER director, who was ousted by Commissioner McCary in his first days, seems to have precipitated her firing. And of course, there have been other high-profile departures. Peter Stein, director of the Office of New Drugs at CEDAR, was pushed out. So was Hilary Marston, FDA's CMO, and many others. And some have jumped before they were pushed, notably 2 senior officials in the Oncology Center of Excellence. So what does all this mean? My take, this points to a possible 2-track future in the near term for FDA. Products with ambiguous efficacy and safety profiles could face a longer, less predictable path to approval, while those with clear-cut benefits could be fast-tracked to market and get there quicker. And the reason I say the latter part is because Commissioner McCary has committed to eliminating red tape. He's committed to meeting PDUFA goals. He wants to show that the appearance and the reality of FDA moving more quickly on approvals when it's possible. So that, again, I think you'll see those two things happening. And the reason that other things that are more ambiguous, could be slower or could be more difficult to get approved at all. I think, one, because Dr. Prasad has expressed skepticism over some of FDA's approvals in the past that were based on accelerated approvals of therapies where the data was ambiguous. And two, because when you have a lack of senior people or you have very new people at the top at both centers, the natural tendency for staff is to avoid taking risks, to avoid sticking their neck out. And you put on top of that the fact that something like 20% of FDA staff have walked out the door since January. That makes it much more difficult for them basically to do anything that's not kind of on a predictable glide path to approval. What I'm hearing from companies is that it's also impairing FDA's ability to give timely and helpful advice to companies that are developing drugs. That advice is most important for the smallest companies, and especially for the smallest companies when they're trying to trod new territory that hasn't led to approvals in the past. So all of those, I think, suggest that we're going to see this kind of two-track. One final thing, I think that we're likely to see a higher degree of coordination between CBER and the Oncology Center of Excellence as a result of some of these changes. And I think we may see some of the kind of more pragmatic approaches to reviews that have been pioneered at the Oncology Center of Excellence and at CDER under the kind of mentorship of OCE. I think we may see some of those being adopted more broadly at CBER and at CDER, not just for cancer drugs, but kind of diffused a little bit more through the agency.
So, Steve, a couple of things in there. I mean, greater coordination with the OCE does sound to me like a move in the right direction. You know, I expect there's a lot of expertise that could be benefited from across those different cancer types of therapy. Just in terms of predictability of FDA, this is drug developers' big concern. I mean, we do hear of people saying, you know, I had great interactions, I'm getting things done on time, and you know, there are positive reports. There are also negative reports, as we know. But I think the main thing people worry about is predictability. Does this change your view of that?
I think it creates more turbulence. It creates more unpredictability. I think that there's some readouts that are going to be coming in the next few months. They're going to give us some sense in the short term of where things are, particularly at CBER. There are readouts of and at CDER of therapies for rare disease. There's a cluster of rare diseases, MPS disorders. There are, I think, 2 gene therapies that are coming up and an enzyme replacement therapy that are coming up that are the approvals are resting very heavily on a biomarker, heparan sulfate. It'll be very interesting to see what happens with those. There's a gene therapy for cardiomyopathy associated with DMD. There was supposed to be an advisory committee meeting that was abruptly canceled. The advisory committee meeting was canceled for that. So we'll see what happens with that. Some of the other approvals decisions that are coming up in the next few months will give some idea, give some level of predictability for what's happening. But so much of what FDA does isn't transparent. People outside of the companies that are actually dealing with the agency don't necessarily know what's happening. And these are the really important interactions that happen long before a product is submitted for approval, the things that are happening at the end of phase 2 meetings, for example. Those kinds of interactions are really going to be critical going forward. And those are the kinds of things that can suffer when you have both a lack of expertise, a lack of experience and veteran staff at the agency, and uncertainty about kind of what the direction of leadership.
All right, thanks for that, Steve. One other thing at FDA that went down in the past few days, Marty Makary, who, as you've pointed out, is hoping to streamline reviews of innovative drugs, has unveiled what is being called the Commissioner's National Priority Voucher. It'll be available to U.S. biopharmas What can you tell us about this? What are the criteria for awarding one of these vouchers?
So I have to take a step back. So you said that it's going to be available to U.S. companies. That's what I've reported. It's interesting. So Dr. McCary used that expression in a video announcement of it. He said this is going to be available. It's a national security oriented voucher, and it's going to be available to U.S. companies. I sent a query to the press secretary at HHS trying to get clarity on that. She told me, yeah, it's going to be available for U.S. companies. I spoke with people at FDA who are going to be responsible for designing and implementing it. They didn't know what that meant. And, it's a little bit unclear as to whether that's really going to be the case. If it is, I think it would be extraordinary. In the past, traditionally, the FDA's North Star has been that its actions should benefit the public health and patients. I would find it very difficult to square that with a policy that would reserve some kind of an incentive or some kind of a voucher that's supposed to speed the development of therapies to only companies that are headquartered in the United States. I really have a hard time believing that in the end that's what it's really going to be, but that's what FDA has said. The selection criteria are broad. The materials that FDA has produced so far have said that the FDA commissioner will use specific criteria to make the vouchers available to companies that are aligned with the national health priorities of addressing a health crisis in the U.S., delivering more innovative cures for the American people, addressing unmet public health needs, or increasing domestic drug manufacturing as a national security issue. One of the things that's very interesting about the approach as it's been announced is that the vouchers, which, by the way, are not really a traditional view of a voucher because they're not transferable. This is more like it's a pathway. In any case, this program is going to be available both for a specific therapy that's under development, or it can be awarded to a company, and that company can use it for any product in its pipeline that it wants. That's an unusual approach, and it fits with this goal of increasing domestic drug manufacturing. It could be used as a kind of reward for companies that expand or launch new drug manufacturing in the United States. So what's the voucher going to get you? Basically, the way that it's been described so far is that companies will be able to do rolling submissions. They'll be encouraged to submit as much of their data as possible prior to the conclusion of their pivotal trial. And then the idea is that once the pivotal trial data comes in, FDA will launch a very, very rapid review of it. Commissioner McCary has said that that review could be completed in a month. And part of that review will be an approach that he says is going to be like a tumor board. That's what is used in oncology when interdisciplinary group of physicians confer about an individual patient's case, their tumor, and decide what the best course of action on it is. So Dr. McCary said that he's going to use this approach to accelerate this final review once the pivotal data has come in. Again, I've spoken with people at FDA who would be responsible for making this happen. And they said that the first that they heard about it was in the press release that was put out by FDA. And it isn't really clear to them exactly what it means or exactly how they're going to put it into effect. The other thing that hasn't been announced is how many companies are going to be eligible for it. It's been described as a pilot program that will be available to a select number of companies in the first year. But there hasn't been any more information released about how many of those companies or exactly what the process is going to be for selecting them.
All right. Thank you for the intelligence on that, Steve. Please do keep us informed as you learn more specifics around those vouchers. One last thing before we go today. Steve, you were up at Bio last week, and I know you caught up with Fritz Bittenbender, who is the new chair of Bio. Is that right?
I did. The Q&A is on BioCentury's website. It was an excellent conversation. He was surprisingly candid about a number of things. One of the things that I asked him about is his thoughts of how the negotiations, the discussions with the White House and with the administration on MFN, the most favored nation drug pricing policy of the Trump administration, how those negotiations are going, how they might come out. I don't want to steal the thunder. You should read the Q&A and find out what he said, but it was quite illuminating.
Okay, well, I will drop a link in the show notes to Steve's Q&A with Fritz Bittenbender. Thanks for tuning in. We'll be back next week here on BioCentury This Week.
BioCentury would like to thank Icon Biotech for supporting the BioCentury This Week podcast. To learn more about how Icon Biotech can help you meet your critical milestones, go to iconplc.com/biotech.